Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling & Sterling, Urban American, The Wickoff Group.
So what's happening in the world of banking? What's happening in the economy? How are we looking today? I mean, oil is up, there's crisis in the Middle East, and, but there's the exuberance in New York City that the real estate market's doing great. So today I brought together 4 individuals, 4 real bankers, even one who says he's not a banker, but he really is a banker, to provide their insight on the state of the market. My guests today include Gino Martocci, who is the president of the New York and Long Island region of M&T Bank, Dan Harris, who is the executive vice president and chief lending officer at the Dimes Savings Bank of Williamsburg, Ralph Hertzkel, who's the president and CEO of Meridian Capital Group, and also a principal and shareholder at Ladder Capital and Beach Street. And last but not least, the man who's been in banking about 46 years of his life, my good friend Joe Ficalora, who's the president and CEO of the $41.2 billion New York Community Bank Corp. So Joe,
yes,
you've been around the business a long time. How do you see the world today?
I would guess that we're sitting on the edge of a very uncertain environment. There's no question that there are going to be challenges in front of us. Some of those challenges are going to come from outside the country, and some of those challenges are going to come from the existing turn in the credit cycle. So we've come off of a long, very robust, positive credit cycle, all cycles reflecting the one that precedes them. This cycle is going to be long, and it has a lot to adjust for. So some markets adjusted early, some markets will adjust late. In the depths of the 8-9 period, 18 states had significant decrease in value of real estate. There were 32 other states. So the chances that we have a continuing period of uncertainty are very real.
So what are we going to do? I mean, how do you look at it? I mean, Ralph was saying just before the broadcast that we have all this money coming due on loans that were originated in 2006, 2007, are coming due in 2011, 2012. Who's going to be there to take the slack? What's going to happen, Gino?
Well, there's a couple of things. One, I'm of the opinion, despite structural deficits and municipalities, states, federal government, that the U.S. economy is very resilient. And that's particularly true, I think, of New York City because of primarily, I think, because of the global growth and because of its position in financial services industry. I mean, the global economy is growing at 5%, and I think New York's a beneficiary of that. So to the extent that you're in New York or Washington, I think you can expect reasonably robust growth going forward. And given the fact that we've had really no building of office buildings, residential building now for 3 years, once that turn starts, once the corporate profits, which are once again at record levels, start being redeployed and people start doing CapEx and hiring, I think you're going to see a fairly robust turn up in rents, both residential, office. You've seen it, you're seeing it in hotels. However, all that optimism has to be tempered by what Joe just said.
But let me give you the situation. I did a show a couple weeks ago with building owners, and they brought up a very interesting point. You know, we call it the tape measure. The tape measure is, you know, rentable versus usable space. And Eric Garau said that we've already made the tape measure. We can't make the tape measure any larger than it is today on the loss factor. So it's an artificial situation. And when a landlord rents an office building, there's a base taxes, and the real estate taxes are up, and there's a base utilities, and the utility prices are going up. So I think that's a difficult time. Dan?
It's a very challenging environment. As a New York City multifamily lender, that area has remained fairly robust. Retail seems to be improving, at least not bottomed out anymore in the city. Office seems to be, we're starting to see some decent leasing throughout the city. But it's clearly challenging, and the expense factor on these buildings, the real estate taxes have gone up, and actually they've moderated those, and now they're hitting everyone's sewer, and water is becoming a much more significant
But when you
piece of their
take
bill.
into consideration real estate taxes, water, sewer, insurance, I mean, all of this has an effect. Ralph?
You know, I have the luxury of sitting at a different level than bankers because I see deals every day that can get done at certain lenders and cannot get done. And I'm seeing some very interesting, situations where you're seeing a tremendous amount of fresh equity coming into transactions. So I think that the deleveraging process, and you've seen some deals get done recently in New York City, where a deal will trade for $400 million, and over $200 million of it is real equity from substantial owners.
But here's an interesting situation. 1 year ago, or maybe 15 months ago, I was doing a seminar. I was speaking for Bank of America in front of their bankers. I was talking about the refinancing of the Viacom building, 1515 Broadway, and I said, they did refinance it with Bank of China, but unfortunately, the borrower had to put a lot of equity in, even though it was a refinance, because the debt service didn't meet the requirements over there. So there was a need to put additional capital. Not everybody's a strong borrower. That weak borrower, look at what's happening to the foreclosures, that have recently happened. Because of the weak borrower, these guys who may have been a private equity fund, they don't have the situation, or they've capped out. They're giving back the buildings.
Or they're bringing in fresh equity. But the new person that's coming in is deleveraging it. And I believe a lot of the loans that are being made today are all based on current cash flows. And yes, taxes are increasing, but we're in a city where the vacancy factor is decreasing on a daily basis.
Can we talk, you talk about current cash flows and decreasing. When you build a new residential apartment house rental, or you build a new condominium or a hotel, we don't have current cash flows. How does a bank, who has to produce, $4.5 billion of new loans, how do you look at a construction loan today, Joe?
Well, you have to take into account what information is actually available.
I'm not disagreeing, but how would, NYCB has really a very, very low loan losses. They've done a great job. But you know what? Somebody's going to come to Gino and say, I want to build a new apartment house. And I do remember rather well, a couple of years ago, Ralph was involved with the deal, and I threw my 2 cents in on West End Avenue because I felt it was a building where there was a good situation over there, Barnett's building over there. But that's an established builder, a certain number of units. How do you look at a new deal?
Well, we wouldn't deal with a new builder. But before I go on, I want to say that I'm in agreement with everybody with regard to New York. Despite what I said, that was generally in the whole market, not in the New York market. New York is stronger than the rest of the country. And there's no question, whether you're talking to bankers, you're talking to builders, you're talking to other property owners, there is clear evidence that New York is much stronger today than it was 6 months ago, 12 months ago, 18 months ago.
And much stronger than the last cycle.
That's right.
A third of the job losses, much less oversupply,
Yep.
on and on.
So despite all of the difficulties in the financial sector, New York is doing quite well in comparison to the rest of the country. And I think you touched upon it. The world really wants to be in New York. So we continue to have interest coming from many, many different places, and that helps values. But with regard to new construction, you have to be significantly more cautious with regard to starting something new. Even though there hasn't been much building in the last 3 years, the reality is that you want to be very careful in getting involved in new construction, because by the time it's completed, we could have a different place in the cycle. The one thing that is not certain is the future, because it's a very volatile environment, and there are so many things that can impact generally the economy, the larger economy.
You know, we talk about New York. I mean, Gino, M&T, you know, lends in many states. You lend in a number of states. You really are in the local states. New Jersey, the office market is horrendous. Westchester, it's a similar situation. The rents were the same 20 years ago. Even Long Island hasn't been the greatest place. How do you look at a deal? How do you look at it? How do you look at the suburban market? Dan, Gino?
Well, I mean, Westchester's always been a 15% vacancy market. It just, you know, the rents go from 19 to 23 and then back down to 19 over different cycles, and New Jersey's not much different. You better be underwriting it at 15 or 20% vacancies, and even then, if you know, we prefer, when we do office, we prefer a lot of small tenants. You know, we're a small bank, we're a $4 billion bank.
So you want to mitigate your risk of any one large
I don't want anyone with
moving
12,000 or 15 or 20,000 feet in a 40,000 square foot building. I want a bunch of 3,000 foot tenants. So if we lose a couple, it's okay. You lose one big tenant and we're all in trouble. So I mean, that's how we underwrite it.
I think all the banks here have a pretty good handle on what rents are in a given in this marketplace. I mean, we have a big enough portfolios that we can see what rents are. We have a database. We can see go in and see what people are actually paying. So long as you're not premising your loan on rents that are increasing sort of 10% a year for the next 3 years, but on existing cash flows, and particularly where you've got a 421A and it's a rent stabilized situation, I think I think we can understand what the rents will be.
Here's
what we don't understand is what interest rates are going to be 3 years from now.
Correct. I mean, we've had these low artificial interest rates for so many years. I remember, because I'm a little older than some of the people in this room, when prime was, you know, when we had 20%, 16%, 17%. I mean, we haven't seen, I mean, even when Ralph started Meridian, I mean, rates were a totally different world. I mean, we've had this low rate, and a number of buildings are being able to refinance or be financed because they're LIBOR rated. I mean, when have we seen LIBOR last for such a period of time? What happens when LIBOR goes up, because it's going to go up? What happens when prime goes up? Where do you see that?
But also, what happens when fuel goes up?
Fuel is going up.
Has.
I mean, because, and let's, you know, you talk about fuel, let's look at the situation. Urban retail is fine because there's a lack of urban retail. People need that in the situation. But urban retail, you're going to go out to the suburban shopping center, people are going to say, I'm going to stay closer. I'm not riding over there with $5 of gas. I heard on the TV today that they said it's going to cost the average consumer at least $700 to $800 more for gasoline. You know, something has to go. You want to talk about clothing? Cotton has gone up 40% this year. You know, Michael LaMonaco said on the other thing, meat in the restaurants. I mean, these are all major situations. How do we, you know, how do we look at the world like that?
With a great deal of concern.
I mean, hey, you have major presence in Florida. You have a major presence in Cleveland, and you have presence in Arizona. In Arizona. Yeah. How do you look at those markets?
But in those markets, we are mainly a depository. So we don't have any assets in those markets that we acquired in the deal. There were no assets that came with those branches.
But are you going to lend in those markets?
The only lending that we're doing in those markets is through our mortgage company, and we're lending for Fannie and Freddie. We're not lending for portfolio. So we're not taking portfolio risk in those markets, but we are lending for our customers.
It is those kind of markets that are really sharply impacted by $4 gas and $5 gas. I think
right.
$4 seems to be the breaking point where people start to really retrench.
I mean, look at the situation. You know, take Arizona, take Florida. Besides the $4, you're talking about people who thought that, you know, when they retired, I mean, the baby boomer situation, that the retirement, they would be getting a CD at 5%. They're getting a CD at 1.25%. The value is down.
Maybe.
Okay, if they're getting that as a CD rate, so the value is down, and we're in a circumstance that the Social Security isn't up there. I mean, this is a difficult time. You know, how do they pay that? I mean, you look at the cost of, there was a survey that you were flying JetBlue down from New York to Florida. It's gone up from $200, the best ticket, to $260. And that's over a 2-month period of time. I mean, this is, you know, it's a circumstance. What about the CMBS market? I mean, it's come back. What are you seeing, Ralph?
We're seeing a very active CMBS market. I think there is an appetite for the paper from investors. And I think it's a much more disciplined market than it was. I think it's all based on cash flow. There are a handful of investment banks that are writing these loans, and they're being pretty cautious. I think it's for some of the out of state.
But isn't it true that they're still taking no risk? I mean, there were some potential
legislation. There's risk in it. There's risk because a deal can get kicked out. There's reputational risk. I think when it's Morgan Stanley and J.P. Morgan and Citibank, these are big institutions with real balance sheets behind these things. They're very cautious in what they're doing.
I think it's the 22 new entrants that came in at the end of last year that you'll see a washout over the next 18 months, probably, for those guys. With the guys with the balance sheet surviving and probably thriving and filling a need in the marketplace. But to your point earlier, this whole recovery has been interest rate dependent. I had an economist in my office yesterday that's predicting a 6% 10-year by the end of the summer. I think all bets are off if that's the case.
I'm sorry, Jim.
Go ahead.
What is amazing is, Ralph alluded to before, the amount of liquidity in the market is just mind-boggling. And people just don't know where to invest their money in the short term and the long term. So a CMBS comes out and they can put 10 or 15 million or 20 million or $1 billion off their balance sheet for a while, even though the returns aren't that good and it's rated AA or AAA. They're going to do it right now. PIMCO getting out of treasuries yesterday announced. I mean, there's so much money out there that, with our bank portfolios, I can tell you that, when there's a problem loan, or if a borrower's having trouble, they're bringing fresh equity to their deal, and all of a sudden our problems are cured because they either lever it down or they have a big reserve to carry for the next few years. What's amazing, unlike '92, is there's so much money out there to help resolve these issues.
Ralph, I pose this question more because Dan's more in the multifamily, and like your insight and Gino and Joe's insight. Do you, 2 years ago, if somebody came to you and they said, I'm buying a piece of development land, I'd like a loan, the person would say, forget it,
Forget about 2 years ago. If they came to me today, what would I say?
That's exactly my question.
Oh, good. It all depends who the sponsor is. It's all, I believe, to answer your question about construction loans or any loans, it's sponsor driven. The real thing that I think the banks have learned and the industry has learned, that strong sponsors make it through any market. There's no bad real estate deal. It's either over leveraged or you have a bad sponsor. When you have a good sponsor, even if it's a little over leveraged, they work through it, they put in fresh equity. And I think there are land loans that are getting done in New York City right now because of who the sponsors are. And they're willing to sign. They're willing to put their real equity.
Land is selling. I just recently completed an article showing that land is selling in New York City for $300 a foot, $350.
In Manhattan.
In Manhattan. And there was a site being sold in Brooklyn right on Bedford Avenue in Williamsburg, which will sell for $150 a foot because it's next to the subway. The convenience of that over there. My question is not really on that. I think it relates to something that you alluded to, the good borrower. And I brought this up at the symposium that Gino was on a couple of months ago. If a borrower, in the 90s, if a borrower fought with you over a deal, they couldn't come back to you. I mean, there have been workouts. People have done workouts. If the borrower did a workout with you and was helpful, would you relent to them, or would you have, as I called it before, the scarlet letter saying, oh, that borrower was a bad person, they fought with me? I mean, you're the banker, you've been in this business.
Well, you make a valid point. During times when there is obviously more money available than there's product, you're going to be a little more reasonable about who you're going to do business with. During times when it's the opposite, you're going to be much more selective. obviously we've come off of a difficult period, and I think everybody in the room has a good reputation for lending well.
I didn't say that, but my question is more of the borrower. Here's a borrower. Let's say there have been some office buildings in Manhattan where the where the people have given back the property. Back to Bank of America, back to XYZ Bank or Wells Fargo, or so on. If the borrower was working with you, would you continue to lend?
Were they transparent? Were they honest? Did they do everything
Thank
they
you.
could?
That's exactly.
yeah,
That's my question.
Was it purely a matter of
Market.
bad timing, and they really fought and came to you early and did everything they could? I'll have one response for that guy and another response for someone who got a little squirrely during the conversations and didn't stand up.
Right.
Those guys, we have very long tenure, not as long as Joe, but very long tenure at our organization, and we don't forget.
No, and I think that's an important situation. 47.3 million visitors to New York City last year. The hotel industry, was the first to get hurt and the first to recover. But now there's still new hotels being built. What's your thought about the new hotels being built and the sources of getting financing, Joe?
Well, we're not, a hotel lender. We just don't feel comfortable with hotels. That's now and before.
Gino?
We have a number of hotels in New York City. All of them are performing very strongly right now. The turnaround's been dramatic. We never put much more than 50 or 55% leverage on a hotel. The long-term owners, the guys who really want to own it for a long time, they don't put more leverage than that on usually. They may put 60 on, but they understand the cycles. If somebody came to me today, I've got several people coming to me today. We really are very focused on loan per key. These hotels where it's $700,000, $800,000, $1 million a key, we don't play in that game. The limited service with strong owners, and again, back to sponsorship differentiation, where it's $240,000, $250,000 a key, which is our average exposure in Manhattan, we like that stuff.
Ralph, what are you seeing? A lot of hotels, A, B, C, and D type of
Yeah, and
hotels being
we're
built.
currently in the market with a few deals. There are certain lenders, but again, no one is giving, no one's going above 60% of leverage on a construction. It's got to have a real story, and it's got to have some recourse during the construction, and it's all sponsorship driven. And I think if you really look at, there's been very few defaults through the cycle in New York City hotels. Go out of New York City, it is atrocious. You have 70% losses on hotels. And, a bank recently came to me and said, what do you think about lending in hotels? And I said, I'm not a hotel expert. You're not a hotel expert. Why make hotel loans unless they're 40, 50% loan to values? And you got to get it's really lending to a business as opposed to real estate. And the right banks that have the expertise knew exactly how to do it, and it'll continue.
So
to get done.
here's a question, and it relates to asset classes, which I always discuss. I mean, sitting with Joe, you know that NYCB and the Dime, the major asset class that they like is rent-regulated multifamily. Gino would like to do it also, but these guys like it even more. Hotels, we've heard your discussion. Construction, we know. What about industrial? What about office buildings? I mean, Joe did a great office building, as you said prior to the show, with lots of equity in it. 1330 Avenue Americas is a dynamic building, great sponsorship, and lots of equity. I know you've done on Fifth Avenue for the Kaufmans and Invesco over there. What do you see as a product type that lenders are shying away from?
Shying away? Well, I think
Storage or is
hotels, storage.
Storage?
Yeah.
Dan?
Right now, the big box retail, you really have to understand who's running the box and how they're doing. Some are doing quite well,
I think
some
you
not
bring
so
out
much.
a great comment. When Borders went Chapter 11, people said, what's next? And, if we age ourselves and we look back 10 years ago, they were Coconuts, they were Sam Goody, there were these record stores. You don't see record stores now. That has been taken care of. And you know what? You will have Barnes & Nobles, but you may have a smaller amount of Barnes & Nobles. And you won't see Walden Books, you won't see the small little bookstore over there. People are very worried right now, even on Best Buy. Even though they're the last survivor, they're worried about Best Buy because people can go to the internet. Best Buy doesn't have that special complex like the Apple Store. It's one price, you can't beat it, and they also give a service. I mean, that's when you look at retail, suburban retail. How do you look at suburban retail?
We prefer urban retail strip centers. We like multi-tenanted strip centers better. Urban, suburban retail is a little dicey right now. Most neighborhoods I know in Westchester, where I'm from, and there's some dark spaces, not large, but voluminous. The vacancy's up.
We believe in the reurbanization of America, and so we like urban retail too. I think suburban retail, it's a little tougher. It's a little tougher to know the trends.
You have a major presence in Long Island. You also have a large presence in New Jersey. How do you look at those markets?
Same way. The closer you are to an urban area, the greater the likelihood that you're going to get the rents that you're requiring on that property. There's no escaping the fact that in the period ahead, we could have a lot of difficulty with fuel. So suburban becomes more difficult to get to. And certainly it presents a whole array of additional challenges. So sticking with urban, I think, would be good for all of us.
Here's a question, and I know you and I have discussed this many times on the show, and because you called the recession before anyone else called the recession. Are we in for a dip again? Are we back for a double dip? I mean, the market went up to 12,000. After 2 years, it went from 6,500. Are we back?
Dips come with momentum, and the psychology of a dip could easily evolve in the period ahead, and that could be triggered by a confluence of several different things, some of them foreign, some of them local. But the reality is that real estate, which was trillions of dollars of contribution to the expansion of the economy, and I'm not talking here about the commercial, but I'm talking more about the 1 to 4 family, is in jeopardy because you have an awful lot of intervention by the government which is delaying access to defaulting real estate. Everybody that's in real estate knows that time from default to disposition actually decides magnitude of loss. So by the government intervening, they're increasing the amount to be lost on real estate, and they're also decreasing the number of eligible buyers because as they set rules that make it harder for lenders will require more money down, higher FICOs. That will lessen the number of eligible buyers. That will also cause downward pressure on the value of real estate. You don't have B of A putting $1 trillion in house loans in a bad bank without a realization on their part that this is a difficult market. And at the same time, they talk about the settlement with the attorney generals. Contemplate. The attorney generals across the country are figuring out ways not to let foreclosures occur. That's very bad for the economy.
I wish we could continue, but 30 minutes have gone, and I think we've got a lot of insight on the market, the financing, and what's happening. I'd like to thank Gino Martocci, Dan Harris, Ralph Hertzker, and Joe Ficalora. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Sterling and Sterling, Urban American, the Wyckoff Group.